Have you ever noticed that the biggest opportunities in the stock market often appear at the exact moment when everyone else is running for the exits? It sounds backwards, doesn't it? Yet, that's the uncomfortable truth behind some of history's greatest investment successes. The psychology behind contrarian investing isn't about being stubborn or trying to outsmart everyone. It's about mastering one opponent that most investors never defeat: their own emotions. John Templeton once built his fortune by buying when fear was at its highest. While the crowd saw disaster, he saw discounted value. That raises an important question. If the strategy is so effective, why don't more people do it? The answer lies deep in human psychology. We're wired to seek safety in numbers. When markets crash, fear spreads faster than facts. News headlines become darker, conversations turn pessimistic, and suddenly, selling feels like the only sensible choice. This is herd mentality in action. It protected our ancestors from danger, but in investing, it often leads people to sell low and buy high. Think back to the 2008 financial crisis or the market collapse during the COVID-19 pandemic. Panic dominated every headline. Many investors rushed to cash because they couldn't imagine recovery. Yet disciplined contrarian investors recognized something different. They understood that markets have historically recovered and that periods of extreme fear often create the best long-term buying opportunities. But here's the catch. Buying when everyone else is selling feels emotionally painful. That's because of loss aversion. We fear losing money far more than we enjoy making it. Add confirmation bias, where we only believe information that supports our fears, and it's easy to see why so many investors miss life's greatest opportunities. John Templeton believed that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. That's more than a clever quote. It's a roadmap for understanding investor psychology. The crowd usually reacts to emotions. Great investors react to value. The next time fear dominates the market, don't just ask what everyone else is doing. Ask whether the crowd is thinking emotionally or rationally. Sometimes the most profitable path is the one that feels the most uncomfortable. If you enjoy exploring timeless investing lessons and the psychology behind building lasting wealth, subscribe and join us for the next conversation.